Hello, everyone, and welcome to another episode of Proinvestor Insights, where we decode the latest earnings reports and financial updates to help you make informed investment decisions. Today, we'll dive into some detailed highlights and insights from the recent earnings results. We'll cover essential numbers, performance metrics, and forward-looking statements to give you a clear perspective on these companies' financial health and strategic plans. Syrma SGS Technology strong operational performance driven by strategic mix change. Syrma SGS Technology recently delivered a robust operational performance. The company's earnings saw an expansion in its EBITDA, increasing by 150 basis points year-on-year and a solid 460 basis points quarter-on-quarter, landing at 8.5%. This improvement was largely driven by reducing the lower-margin consumer business in its revenue mix. On the back of better operational efficiency, Syrma posted a positive cash flow of 2.1 billion Indian rupees for the first half of FY25, with its net working capital days dropping from 85 days last year to 57 days this half. The company has an impressive order book at 48 billion Indian rupees, with high visibility into continued growth, especially in higher-margin segments like industrial, healthcare, and exports. Syrma expects around 40–45% revenue growth for FY25 with a 7% operating margin, driven by the growth in exports, projected to rise by 20–25%, and an increased share of high-margin segments. Syrma's management has maintained a positive outlook, with gradual margin expansions anticipated due to a diversified and optimized revenue mix. Earnings highlights and strategic shifts. Syrma's revenue saw a 17% year-on-year growth, reaching 8.3 billion Indian rupees, although there was a sequential drop due to seasonal factors. Gross margins expanded by 190 basis points year-on-year to 24.4%, a result of strategically reducing reliance on the lower-margin consumer business. EBITDA grew 42% year-on-year, and APAT increased by 22%, supported by effective cost management. On a sectoral basis, Syrma's automotive revenue grew by 22% year-on-year, accounting for 25% of the total mix, while industrial revenue saw a 23% year-on-year growth, making up 29% of the revenue mix. The healthcare segment also posted robust growth at 29%, reflecting Syrma's focus on high-growth, high-margin verticals. Business outlook and guidance. In terms of future guidance, Syrma's management remains optimistic. They expect the higher-margin industrial and healthcare segments to continue their upward trajectory, with the consumer segment stabilizing around a more strategic 35–40% share of the total revenue mix. The company has also emphasized its commitment to keeping net working capital days under 60, supported by streamlined operational efficiencies. Additionally, their newly commissioned facility in Pune is expected to reach peak revenue potential, offering a solid foundation for their projected top-line growth. Export growth is another area Syrma is doubling down on, already contributing 23% of revenues, with a forecasted growth of 20–25% in FY25. Their focus on the high-margin export market is part of a larger strategy to drive sustainable profitability and enhance their competitive edge globally. Thank you for tuning in to Proinvestor Insights, where we strive to bring clarity to stock market complexities and support your investment journey. At Proinvestor AI, we are committed to providing tools and insights that help you make better, data-driven investment decisions. Remember, this is just an overview. For the full investor conference call and detailed discussion, head over to the Proinvestor YouTube channel to stay up to date with the latest in stock market insights. Until next time, keep investing wisely with Proinvestor AI, your trusted partner in the stock market.